We're joined now by Bill Rhodes, President and CEO of William Rhodes Global Advisors, also author of Banker to the World. Bill, I know you're back from a recent trip to France and possibly other places in Europe. What European concern is most front of mind for you?
Well, I think when you're in the Eurozone area, it's obviously Italy. But now you have the Merkel situation, which is not a surprise given the weakness she's shown in these recent elections. I think she opened Pandora's box, which I said on your show earlier this year and last year with the immigration policies that she's taken. And so you take that into account, plus the uncertainties over Brexit, and I think Europe is in a difficult situation. You saw the growth figures that came out yesterday, half of what was projected. And yet Mario Draghi says he's going to stick to his guns and stop quantitative easing at the end of the year. So I think the Eurozone has a lot of problems, and Macron has started on his reform process, but his ratings have dropped now to the low 30s, and so I think it's a very difficult picture that we're looking at in Europe. And then, of course, we have the China situation.
Is this a global malaise, Bill, or is it particularly related to the European project?
Well, I think Europe has its own problems with the project, and then with Brexit, be it the EU or the Eurozone. But then you have to take a look at what's going on in China, because we tend to forget it's the world's second largest economy. When you take the United States, China, and Europe together, you have the biggest economies in the world. And all of them, except the U.S., are having problems. I mean, China, growth is slowing. We saw the manufacturing index go down. I think they're going to have a tough time just keeping over 6% going forward. The figures that came out a few days ago showed 6.5%, which was the lowest they've had since 2009. But I think it's more serious than that, because what's going on in the trade wars. And you see what's happening with the stock markets in China. The government is now intervening actively, sometimes indirectly, but intervening. The People's Bank of China, the central bank, has dropped the reserve requirements a couple of times recently for banks to get them out and stimulate them. But when you have debt to GDP at over 300% and growing, you got to be concerned, for the future. So I think this trade war has affected, obviously, China much more than it has the United States up to date. But it's not a great situation, that's for sure.
Bill, good morning from London. Guy Johnson here. Earlier on, the Politburo I'm very well. Nice to see you. We did see the Chinese leadership meeting earlier on today, and we've seen a new sense of urgency certainly being generated by Xi Jinping and the rest of the leadership. How do they counter? What tools, what levers are the Chinese authorities going to pull in terms of stabilizing the Chinese economy as a result of the threat you just mentioned from the trade war?
Well, you certainly can't do it overnight. I think the People's Bank of China is doing what it can on reserve requirements. I think one of the real problems here is the borrowing by municipalities, provinces, and frankly, the state-owned enterprises. And that's not a task that you can rectify overnight. The last one to take this on, and the economy was so much smaller, was Zhu, and that was 25 years ago. Most people don't see a Zhu in that role at this point. So it's not going to be easy. I think people in China, as well as observers outside of China, are hoping that in this meeting between Xi Jinping and President Trump at the G20 at the end of November in Argentina, something may be worked out. But it's not clear because most people think the cards at this point are in President Trump's hands. But it doesn't suit us to continue this trade war indefinitely. To me, the biggest single problem is not so much trade, but intellectual property. And that's where it's going to be very difficult with the Chinese.
How do you think they're going to manage the currency? This is one of the big questions we seem to be grappling with on a daily basis at the moment. The currency moving towards 7 against the US dollar. I guess the delta, the rate of change is important here. But do you think they will ultimately end up weaponizing the currency and using it as part of this trade narrative? Or do you think the fear of capital flight is so great that they will not pull that lever?
I think you got it right on the latter statement. I was there in 15 and 16 when they lost $1 trillion and spent time with then governor of the People's Bank of China, Zhou Xiaochuan, and his deputy Yi Gang, who's now the head of the People's Bank of China. And they understand very well that if they go above 7%, it could cause real repercussions with investors, Chinese investors. And they're concerned that may exacerbate the outflow. So I think it's a very tough game, and fortunately, the best institution in China is the People's Bank of China, and Yi Gang is a real professional. He studied and taught 10 years in the United States at the University of Indiana, and he's a first-rate technician. Of course, he doesn't have the political say, but I think hopefully Xi Jinping will listen to the people at the People's Bank of China, because that's what's needed now.
If China slows, the currency weakens, and the trade war escalates with the United States, can the U.S. remain immune?
Eventually, no. Right now, we're the outlier, fortunately. But over time, we're still a global economy, and we're interrelated to such a degree that over time we can't. I can't, say what this administration has in mind, but I think what they're hoping for is that they can get some sort of an arrangement on intellectual property going forward. That's going to be the tough one. And I think on trade, I think something could be worked out. I'm more concerned about the intellectual property side, which I think is really what the United States and Europe, not just the United States, Europe should be very concerned about. I just recently came back from France, and I talked to a series of senior people in the financial area, past and present, and in the industrial area. And they basically said Trump has got it right. We in the EU and the Eurozone have it wrong, because at the end of the day, we should be as concerned as the U.S. about intellectual property. So I think that's going to be the most difficult thing to work out with China over time.
Is that going to be the next step for Europe then, to actually get into an intellectual property war with China?
Well, the problem, I think, with Europe is that, as we discussed at the opening, they have so many problems with the economy that I think they're so tied up with the situation in Italy. I think also what's going to happen politically in Germany, and the reform effort stalling in France, as well as Brexit. So I don't think the Europeans have their act together in this area, but I think they will. And I think it suits the United States to present some sort of a united front with Europe with regards to China in this area of intellectual property.
Bill, over the last month, the three best performing currencies of the kind of expanded majors group that we like to use here at Bloomberg, and you can find this on the WCRS function, are the Argentinian peso, the Brazilian real, and the Turkish lira. Those three currencies have done incredibly well against the US dollar. Would you, with your knowledge of those economies, put money to work in those three countries right now?
Well, let me take Brazil as a starter. There's tremendous confidence in Paulo Guedes, who's going to be the new super minister of finance under Bolsonaro, on tackling reforms that have not been hit, like the pension fund reform, and I think he will do it. So I think there's optimism within Brazil and outside Brazil in this regard. Argentina, I think it did the right thing with the IMF, the IMF agreement, but now they've got to implement it. And in Argentina, and I restructured them 5 times over how many years, 30 years or something, it's always difficult for Argentina to actually implement these reforms. I'm optimistic somewhat that Macri is now committed to do so. With Turkey, they have a real basic problem, apart from all the politics of Erdogan and what's going on with the EU and the United States and everything, is that the banking system and the private sector has borrowed very heavily short-term in foreign currencies, whether it be dollars or euros. And so any sort of problem that arises is a real concern. I helped them in 1994 and again in 2001 doing their restructuring. And it's the same problem which they haven't resolved. Turkey, you really have to watch, and hopefully Argentina will move ahead. I feel very positive on Brazil at this particular point in time.
Is the U.S. at risk at all from any other country and contagion?
Well, as you know, I've been beating the drums on the emerging markets for the last 6 months, because that's always a warning sign. And I think that contagion is always there. You and I have discussed this over the years, Vonnie. And we've got to be very careful on thinking the United States can be isolated by itself. Let's face it, we're raising interest rates. We're running down the quantitative easing. And if you take those together, and I think Janet Yellen had it right, at least for 2 increases. My own feeling is Powell is going to do more than that. But that all exacerbates the situation with the emerging markets. And, you know, I've seen this movie, many, many times in different languages, but it's always the same. So I think we're in for a period of turbulence. I think a year from now, if we take a look at the world economy, it'll be less rosy than it is today. But there's no doubt that the United States today is a locomotive.